Hey all, welcome to ShareTreck. This is Raj here. Friends, I had some unforeseen problems yesterday and could not record anything yesterday and much of this morning. We had some foreign visitors and one of them got stung by a wasp and within minutes, my visitor had adverse reaction and then we went to the doctors, but the doctor's office was closed for the weekend. So we had to rush her to the emergency at the hospital. There we had to wait for a while before she could be attended. It was very expensive for foreigners in Canada to get emergency attention. It was $750 for registration and another $250 for the doctor's consultation and treatment. So late that night, she was discharged and we had a pizza dinner. And this morning, she's fine and is leaving to her home country. So that's a long story short. And that said, this underscores the importance of healthcare and we are investing in the right field. This brings me to the topic of today's video, Pfizer. Pfizer has a strong brand name and is trading very inexpensive, in my opinion. There's a lot of confusion around the valuation of Pfizer, and I'm joined today by Sandeep as we try to make sense of the data points and arrive at a conclusion. Let me first set stage before I invite Sandeep to share his fundamental analysis. In the early stages of the pandemic, Pfizer emerged as a key player, providing the much-needed COVID-19 vaccine and treatments, including Comirnaty and Paxlovid. Please excuse my pronunciation because I'm not a doctor. I'm not used to pronouncing these therapies. But anyway, this not only helped combat the virus, but also boosted Pfizer's annual revenue to an all-time high of $100 billion last year. However, as we transition towards a post-pandemic era, the certainty of demand for these products, these vaccine products for COVID, has become uncertain. One critical aspect to consider in the changing landscape of COVID-19 vaccine is that initially governments worldwide placed substantial orders for vaccine doses, leading to consistent billion-dollar revenue for vaccine makers. But now, with the virus expected to follow a seasonal pattern similar to the flu, the question is whether how many people will opt for annual coronavirus boosters. And Pfizer and its competitors, Moderna, suggest that roughly half the Americans may choose to get a coronavirus jab each year based on historical flu shot statistics. And the second factor affecting Pfizer's revenue projection is the shift from government orders to private or commercial market for COVID-19 vaccines. In this commercial market, manufacturers can charge higher prices for their vaccines, potentially exceeding $30 per dose that governments have been paying so far. Although Pfizer hasn't disclosed its commercial pricing, it hinted at pricing its vaccine at around $130 per dose, which could potentially compensate for the volumes and a little more. And the next 4 months or 5 months will be crucial for Pfizer as they provide insights into the future of coronavirus vaccine and product revenue. Uncertainties such as vaccination rates and infection rates for Paxlovid are expected to be clarified by the end of this year, probably by the end of Q4, as I said. And despite the uncertainty surrounding coronavirus products, Pfizer is poised for potential growth. And if we look through what CRISPR has done, for example, if you look at their pipeline, which I have always said is a broad pipeline, and then if you look at Pfizer's pipeline, you would be saying that it's a huge difference because Pfizer's pipeline is so much more dense. Let's take a quick look at the pipeline right now. So here we are, and I'm sharing with you the Pfizer pipeline. And as you can see, it's huge. Just look at the vaccines. It's a whole lot of vaccines. And out of that, you will see that phase of development registration is the status for 1, 2, 3, 4, 5, 6. 6 of these vaccines, which means they are going to be monetized immediately in a very short order. And then if you look at phase 3, there are 3 phase 3 vaccines which are in Pfizer's pipeline, and there are 2 in phase 2, and then there are around 4 in phase 1. And now if you look at the other aspects of Pfizer, like there is this summary snapshot, which says that They have discovery projects. They have around 29 in phase 1. They have 28 in phase 2, 23 in phase 3, and 10 in registration, which means 10 are close to monetization. And that's a total of around 90 as of August 1st, 2023. This is huge. If you look at CRISPR Therapeutics, CRISPR has got much less than this in their pipeline. And apart from that, Pfizer has got tons of money in its balance sheet. And now, if you were to look at May 2, 2023, they have got around 101 total in their pipeline. So it is huge. And they have given a breakdown in this PDF. You can go to Pfizer website, look at their pipeline. There's a link for the PDF. You can download this PDF. So they have got 2 anti-infectives in phase 3. One of them is NME, or new molecular entity. Another is product enhancement. And if you go to inflammation and immunology, they have got 2 in phase 3, 1 in registration. And if we were to go into internal medicine, there is 1 in phase 3. And in oncology, they have 2 in registration, which means imminent monetization. And there's a whole lot in phase 3. They're all going to get into registration very soon. So in phase 3, you have got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 of them. So with our genomics watch list, when we have 2 items in phase 3, I mean, we would be so excited. Look at what Pfizer has got. This is what a mature pharma company looks like. And then if you go to rare disease, there is 1 in registration and 1, 2, 3, 4, 5 in phase 3. And in terms of vaccines, I already spoke about this before. They got a whole bunch, 1, 2, 3, 4, 5, 6, 6 of them in registration, 3 in phase 3, 2 in phase 2, and 4 in phase 1. So friends, this is what Pfizer looks like. And the company plans to launch 19 new products or indications over an 18-month period, with several already in progress. Additionally, recent acquisitions could add as much as $25 billion to Pfizer's revenue by 2030. This is where I would like to invite Sandeep, and we'd like to see what Sandeep has got in his fundamental analysis or financial ratios. So hi, Sandeep. Thanks for patiently waiting for me to finish a lengthy background. Can you please share what you have on the fundamental analysis?
Sure, of course. And thank you for having me back again. That was a very detailed analysis of what Pfizer has in their pipeline. And as I was reviewing their most recent earnings, as many of our viewers know, Pfizer was one of the glory age stocks of the coronavirus pandemic era because they came out with the first vaccine and what some people think is one of the more effective vaccines using the mRNA technology. And the company was able to sell this vaccine and get guaranteed money from countries all over the world. And because of that, the stock appreciated quite a bit. The growth rate for that era was huge. It was very, very large, and stockholders were quite happy. However, things have changed since then. The coronavirus pandemic is, we'd like to hope, behind us, and we are now entering more so, despite heavy inflation, more so back to what we were before pandemic. And Pfizer's financials have taken a hit because of that great reality that we could go outside, we could go to movie theaters, we could see our friends. So as I was going through Pfizer's balance sheet, I noticed a few interesting things. Their revenue dropped from what used to be 27 billion to 12 billion.
Wow, that's a huge drop.
Yes, it's a 55% drop in revenue alone. However, thankfully, going through their cash flow statement, going through some of their other statements, much of their other assets, their other expenses have remained relatively constant. One thing I noticed is their goodwill. Goodwill is some non-tangible things, things like patents, things like copyrights. That has remained constant. It's gone up a little bit, nothing too significant. Other things like their inventories haven't really grown that much. Their taxes have remained incredibly constant. their liabilities have remained relatively constant. It's gone up a little bit here or there because they've had to pay out different amounts in bond payments. There's something we'll get into a little later, but it's a very, very constant, very streamlined company because it's a mature company, as Raj was saying earlier. So I want to know, why is their revenue dropping so significantly? And why are they now spending much more money? And why are they having less cash now? Through going through their statements, what I've discovered is one of the main reasons, aside from not selling as many coronavirus vaccines, is bonds. Bond payments.
Oh,
Yes. So, as our viewers might know, the 10-year treasury yield seems to be like the benchmark of what bond yields are and what bond yields yield. So right now, the 10-year treasury is yielding close to 4%. Because of that, the rate of return 4%, these companies are forced to charge even greater to find people to buy their bonds. I was taking a look at Pfizer's bonds. They have bonds yielding 7.5%.
that's very expensive borrowing cost.
Yes. And despite very, very low dilution, their bond payments have gone from spending 3 billion on bond payments to 11 billion just on bond payments, on their interests alone. And because of that, the company has had to use much more cash.
Bleeding
However,
cash, 8 billion more every year.
yes, just in bond payments. However, one thing that I did notice about this company is that they are increasing the amount they're spending on short-term bond payments. Sorry, the amount they're purchasing in short-term bond. This company is pretty smart. They're seeing that the short-term treasury yield, you can see the 10-2 short-term treasuries or the 3-month treasuries are yielding much greater than the long-term treasuries. Because of that, Pfizer is seeing an opportunity to purchase bonds at the short-term treasury rate and kind of roll those bonds, or even get government bonds that are yielding 4.5% for a 3-month treasury, and they could lend at the longer rate, making them much more able to get a preferable position. They're positioning themselves in a way to continually get much more money, much more income coming in.
So you mean they are using the bond proceeds to buy government bonds?
They're using some of their cash position to buy government bonds.
Okay, so that it can subsidize their bond payment.
Yes, yes.
Okay,
They see an opportunity to increase their return. They
okay.
use some of their cash to buy much more government bonds. And that's something that's constant with a lot of these much more mature companies.
Right, and they are buying short-term bonds from government.
Correct.
Okay. That way, the face value, the market value will not fall too much, and they will be able to collect the full principal plus the interest.
Correct.
Okay, sounds good. Yeah.
All right. And one thing I'd like to show our viewers, if I may, is so when we want to value a dividend paying company, one of the things that I like to do is go to this website called Morningstar.
Yeah.
Morningstar, go over to their dividends page and take a look at what dividends they've been paying out. Right now, their dividend yield is about 4.5%.
Oh,
Now, what that means is that is the percent yield of their dividend based off their current stock price. You can see here their dividends have been about 41 cents a share before those 40 cents a share, 39 cents a share, 38 cents a share, and so on and so on. If the stock price right now, about $35, were to go to $40, that dividend yield is actually going to decrease because their dividend payment is going to remain constant. If it will be $40, we'll take 40 cents divided by $40. That is
1%.
yes, about a 1% dividend. You
Yeah.
can see that the dividend will change. But with dividend paying companies, a very, very important ratio is this thing called the payout ratio. This is how much of their revenue, how much of their income they're paying out. You want this to be growing. However, you don't want to be too high, because
Right.
if the payout ratio is far too high, that's indicating that they can't sustain this. They
Right.
can't keep paying out this amount of dividend. So because it's relatively below their revenue, it is sustainable. It's below 50%. And another valuation metric, which I like to use, is this thing called the dividend discount model.
Yeah.
This is something which I'll share with the community. It's very, very technical. The way this little spreadsheet is made, you can play with it yourself, and it's very, very easy. Where the dividend discount model, there's something that Warren Buffett likes to use sometimes. Just put in the dividend payments for the years over here and it'll calculate what the present value is based off the stock price. If we were to plug in the values over here, as I've already did, based off the stock price, it's saying that the intrinsic value of the stock is about $28.
Yeah.
That's much lower.
And I
So
guess it is quoting right now at around $35.
yes.
Okay.
So that would be the situation if we had like almost a PE of 1.
Yeah.
Not going to have a PE of 1 ever.
Right.
Historically, based off the historic pricing, this seems like a pretty good deal.
Yeah. Yeah.
We could go a little further of a constant dividend if you were to always pay the same amount of dividend. This is something which is not going to be the case for Pfizer because they increase their dividends. We would more so use the consistent growth where they always increase by about a penny each dividend, which is 2.4%. If you were to go by this model, the intrinsic value is about $21. I more so like the regular dividend discount model.
Right.
And if we look at this other sheet, which we were looking at before, the PEG ratio, I plugged in the Pfizer value of about $35 a share, and the end of year expected earnings per share about 3.33, which gave us a price to earnings ratio of 10. If we compare that to some of these other really, really large, high multiple tech names, 10
Very low.
low. Because of that drop in revenue, our PEG ratio, price to earnings growth ratio, is negative. However, Pfizer isn't that much of a growth company. It's more so a blue chip, solid, paying out their income through dividends rather than stock appreciation. So I don't think this would be the best way to value a company like Pfizer. Instead, we'd want to take a look at things like what's going on in their pipeline, how they get their revenue. Is their revenue very consistent? And I think so. I think the revenue is actually pretty consistent.
Yeah. And Sandeep, I think, as you mentioned, right, different industries will need different kind of matrices that we have to look at. Can I share a document?
Yes, please.
Yeah. So I look at a website called Simply Wall Street. I find that it has got a whole lot of information available. So I wanted to check out how they look at Pfizer valuation. And so here they are saying the P by E ratio is 9.4x, but that alone doesn't tell me much. So we have a comparison with peers, and you can see here that Pfizer is 9.4 times as compared to Merck, which is very, very highly valued, 89.6 times. And we have Johnson & Johnson at 29.6 and BMS at 16.3x, and Pfizer only at 9.4. So again, I'm looking at this and I'm thinking that Pfizer, compared to its industry, is really inexpensive. And if I go back to the original screen, that is discontinuation. There was a list for discontinuation. Just give me 1 second while I try to find that out. Yeah, programs discontinued from development since May 2. So all the money spent on these programs which are discontinued is something that will probably be tagged on to the successful programs, which will increase their cost, therefore reduce the margin. So this aspect is what we will also have to take into consideration for pharma companies and biotech companies. But it's easier said than done because we don't have information on how much money was spent on this and how much it is costing for the therapies which are in the pipeline. So all those things are a black box item as far as retail investors are concerned. And apart from this, another thing that we have to keep in mind when it comes to these pharma companies is that we have to remember that they have patent protection for a certain number of years now. I think it is 10 years. So at the end of 10 years, the generics will start coming in, and then we will see a sudden drop in the product revenue, just like something similar to what we saw with COVID vaccine revenues. So those things can happen with individual therapies whose patent ends and generics start coming in. So those aspects, again, have to be considered in valuation. And as retail investors, we don't have visibility into that unless we do a lot of efforts. And Sandeep and I are trying to do whatever we can to come to you with a valuation. But whatever we have done is in no means absolutely complete, but it's an effort to go closer to completion in terms of valuing Pfizer in this instance.
Yes.
So Sandeep, please continue. Sorry for my dialogue.
Oh, no, not a problem. That actually brought me closer to what I was going to talk about next, where they had a section in their balance sheet, sorry, a section in their earnings call where they were talking about, as you said, some of their discontinued items.
Yeah.
They were discontinuing and they're doing a separation from this company called Upjohn, which was one of their subsidiaries. Upjohn makes a lot of the drugs, a lot of the other goods that Pfizer sells. However, that has been going on for quite a while, and 90% of the Upjohn separation, which made up much of their expenses, is already completed. Only 10% left. They're selling off very slowly, very consistently. This company realizes if we just do it all at once, it's gonna shock our shareholders. So they're doing it very slowly, very methodically, very, very smartly. Instead, they're spending that money to acquire growing companies. They're buying something called Exelon, which is an oncology play from AstraZeneca. They're also acquiring something called Biohaven and Arena from a few other companies. They're just continually spending their free cash to pick up newer items. And as Raj was saying, as some of those generic plays are coming in after 10 years, they're renewing it with new ways that they could keep their revenue coming in. Talking about revenue, some people are a little worried about the economy outside of the United States. They realize this as well. Their exposure to emerging markets, which primarily are countries like China, like India, they have decreased from 22% to 16%, whereas their revenue from America has increased from 40% to 50%. The company is very smart. They have $44 billion in cash, but their short-term bills, their short-term expenses only make about 34 billion. That's an extra 10 billion in cash that they could spend on acquiring new things, to getting better, growing. And the company, as I was going through their stock dilution, very, very low stock dilution. They care about their shareholders. They have money. They don't need to issue more shares too frequently to get their money. They have other ways. They're smarter.
No
A
equity
debt,
dilution. Yeah.
yes, and a debt to equity ratio of about 6.2, which is good because it's positive. About 70% of their equity is in stock, 30% in debt, which is one of the reasons why they're struggling right now with their bonds. However, I think the company is doing well. Any thoughts on what we're talking about, Raj?
No, that's it. I think my insights were already exhausted. I've already shared my opinion, but I can do a conclusion in case you have finished your part of the analysis.
Oh, I had just a little summary of a few thoughts we were talking.
Sure. Please go ahead.
So in summary, in conclusion, by the way, I still write down paper notes because I am a little old school. In summary, Pfizer, although their revenue has dropped significantly, the company is still positioning itself for the future. The company is thinking about the future. They took a really, really significant hit from the increase in bond yields, where now much of their cash, much of their revenue is going towards paying bonds. However, they see that there is light at the end of the tunnel. They are capitalizing on heavy bond yields now by buying those government bonds and getting their interest payments. Eventually, those bond yields will come down because they always come down. And Pfizer has over $10 billion in cash after paying all of their expenses that they're using to pick up great new subsidiaries, invest in new technology, and keep on renewing their pipeline. The company pays a very consistent dividend. The company's dividend is growing by about a penny each year, and it's trading at a very low valuation, PE about 10. Compared to most names, that's pretty good. Yeah. Even going by Warren Buffett's favorite dividend discount model, company looks pretty nice.
Yeah. Yeah, I agree, Sandeep. I agree with your conclusions. And furthermore, Pfizer's shares are currently trading at an attractive valuation, as you said, around 10 times, slightly below 10 times forward earnings, following a roughly 30% decline in the share price this year. This valuation seems like a compelling opportunity for investors, considering Pfizer, given the company's solid revenue potential, whether or not its coronavirus products continue to perform as blockbuster assets, they still have a whole lot of new products coming up to be monetized, many in phase 3. So in summary, I think Pfizer faces uncertainty in the post-pandemic world regarding the demand for its COVID-19 products. However, the company's diversified product portfolio, ongoing expansion efforts, and the attractive valuations make it an appealing investment option for those looking beyond the pandemic's shadow. And one more factor, I think, is that because the bonds are hurting Pfizer so much, we are at a stage where the Fed is likely to be more benign. And that will also help, because as the yields fall, we don't need the interest rate to be cut. But as the bond yields fall, Pfizer will find some relief. Is that right, Sandeep? That may happen, right? It's all related to bond yields. So out here in Canada also, we have a situation where our statistics organization had undercounted the population by 1 million to 2.5 million. And the central bank is now on a back foot. And it's likely that there may be no interest rate hike in this meeting by Bank of Canada. And Bank of Canada is typically tied by the hip to the US central bank, because US is the biggest trading partner. And for currency stability concerns, we usually mimic what the US does. And in US, it seems like there is going to be a bit of a pause for the time being. And that will all bode well for Pfizer, because as the Fed becomes dovish, bond yields will start falling. And I think that's going to provide an opportunity for Pfizer to become a slightly more efficient in a financial manner. So that's my 2 cents, Sandeep, unless you have anything else.
Well, just one small thing that
Yeah.
I know Pfizer really was in the negative light of the news following some of the controversy after the coronavirus vaccines. However, in the stock market, some of this news doesn't always keep this company down.
Right.
And maybe that might be already behind us. Maybe the company is now, it's already positioning itself for the future, but maybe all that negative news is behind us, and maybe this is an opportunity.
Right, right. That's correct. I mean, that's another factor. There was a drag on it because of the anti-vax sentiment and all those things. So probably that's also going behind us as COVID recedes. And yeah, so I think that's a good summary that we had, and we try to keep the segment short. But friends, there is a lot of things to talk about in Pfizer, and we had to talk. But hope you enjoyed this video, and thanks a lot, Sandeep, for putting in your time on a weekend to help us analyze companies. And we'll come back to you with another company next week. On Monday, you will have a new company, and I'll announce that after discussing with Sandeep,
Yes.
and you can watch out for that. So this is going to be a new feature that we are going to try and keep on going.
Yes.
Thanks for being a subscriber. Thanks for watching our channel, and thanks for being a member. And Sandeep, thank you so much for coming in.
Thank you for having me. Thank you, ShareTreck Universe, for listening to us. If you have any suggestions, put them down in the comments below. And happy Labor Day, everyone.
Thanks, Sandeep. Happy Labor Day, everyone. Bye for now.